Hey guys, welcome back to another episode of Finance in 15. I'm Steven, and I'm joined by Josh and Melissa Stein. Thank you guys both for being here today. So we have a lot to cover today. Let me start us off with some year-to-date indice returns. S&P 500 is up 6.5%. The AG, which is the bond market equivalent to the stock market, up 3%. And international is up 20%. So a lot of stuff going on right now. You know, if we want to first kind of talk about the outlook of the U.S. economy.
So yeah, it's been an interesting year. I think we would all agree. We got off to
that's a nice way of putting it.
yeah, I mean, we got off to a kind of a good start at the beginning of the year, and markets were continuing their trajectory up early this year. And then as we started to build up to some of the tariff talk and some other headwinds that were continuing to develop early in this year, we obviously saw a pretty sharp market pullback, and then in April we had some of the worst days back to back that we've had ever in the S&P 500, which really started to kind of spin things out of.
Well, it started to worry investors too. I mean, we definitely saw a pickup, I think, in anxiety about accounts and where this was heading.
Absolutely, where we got to the point where the S&P 500 was down double digits, NASDAQ was down, I think, close to 20%. Fixed income actually held its ground for the first time in several market pullbacks, and international, interestingly enough, was the leader, which it hasn't been for a very long time. So since then, we've kind of experienced what the markets do, which is come back. The question is usually not if the markets will recover, right? It's how long and when, and at least thus far, year to date, this time, it really didn't take too long. It pretty much took some of the tariff challenges to get worked out, where at least we kind of have some foundation and some context as to kind of how far Trump may or may not take some of these tariffs. Although after some of the news over the weekend, maybe we're kind of moving back a little bit, but I think the markets are at least a little bit more, to say the least, comfortable with the fact that we're likely not going to get spun into a massive global trade war, which I think really was one of the big questions.
Well, and that's always what happens with a knee-jerk reaction in the market. When the market has uncertainty, it tends to just kind of overreact to that. And I mean, back in April, when a lot of this talk was coming out, I mean, that's exactly what we saw it do. But now it's turned out that some of this situation is maybe a little bit more tempered version of what would happen. It looks like it's able to absorb that and process it better, which is also why we didn't want to take all our chips off the table when that risk arose. So we're going to talk a little bit about that and some of the things that we've done to limit downside volatility, but also be able to capture upside potential too, because there are a lot of things going on. There's a lot of geopolitical turmoil. There's a lot of, I guess, political, uncertainty here at home. Economy has been slowing down for some time. Inflation's been higher. Interest rates are higher. Usually that does create some headwinds for profitability in stocks. So we've been really cautiously optimistic. So we do want to share with you a little bit about some of the portfolio changes that we've made in and during that time, and like where we see things moving forward.
Yeah, and that's been almost to kind of go back to what I was saying before, like that's almost the most interesting part here is, despite all these headwinds, you mentioned them, right? We got tariff issues, we got global wars, we have inflation still, and all the major indices pretty much are up. Mm-hmm. Bonds are pretty much up. Yeah. Alternative investments are up, and that's sometimes a challenging place to be, because we as advisors want to make sure that we protect our clients against volatility, and volatility is still large, right? And you just kind of think the overall sentiment of the markets is questionable. But also, as you said, we still need to be in a position to take advantage of growth. And so the question becomes, how much risk versus how much potential growth do we want to take, right? Like, how much do we want to put the foot on the gas or the foot on the brake? And a lot of that is somewhat relative to our clients' objectives. But most people want to make sure that they're protected if we do have some of these big events potentially happen, like a recession or stagflation or things that Steve and I...
Yeah, well, and just a cooling down economy in general. And certainly, especially with our more conservative clients, our retired clients, our clients nearing retirement, we just don't need to take, or nor can we handle that kind of risk in the portfolio. So I know for years now we've been working on other solutions to protecting against equity risk beside bonds, although bonds are, we think they're in a fairly good position right now. We haven't seen interest rates come down yet, so when they do, we might see a bump in appreciation there, and there's a pretty nice yield on the portfolio, so that they're certainly doing their job there. But we've also incorporated other equity hedges into the portfolio that Josh and Steven want to talk a little bit about, that have been able to kind of give us the best of both worlds, for lack of a better description.
Yeah, and that's really the key here, is to try to keep some of the downside risk manageable, but still make sure that we're participating in the growth of the markets. And the funny thing is, if you don't go down as much, you actually don't need as much growth on the upside to just get back to where you would have been. And that smooths out the ride. So you might not need as much rate of return if you don't lose as much when the markets go down to just get to where you need to be. And I think most clients would agree that that's a much more comfortable spot to be in. They're sleeping well at night. Even if you get to the same place in the end, just less volatility along the way can be big emotionally. It can be big from a mental perspective. And mathematically, it actually works arguably just as good, and sometimes in many circumstances even better. And so one of the things that we've been working on well before really we even got into this volatility was starting to kind of scale back the risk and move more towards a concept that we've been talking about in a lot of these meetings that we've done over the course of the year, which is quality. And really where we're looking for quality is in places where we tend to just see less volatility and still have some upside potential. And then in April, when things really started to get pretty intense with the tariff discussions and just a huge amount of uncertainty as far as would this push us into a global recession, would this push us into stagflation, we added some additional hedges using some pretty complex stock options and other really more unique strategies to lower risk. And they've worked. And when the markets were at all-time lows for the year, our portfolios were nowhere near as far down. And although those hedges can potentially not necessarily have as much upside potential as just their broad-based indexes, because they don't go down as much, they don't need as much return upside to kind of stay the course.
So in an environment like this, where we have a lot of uncertainty around where the market's going, we think it might be cooling off, it's good to have a strategy where we can leave some of our chips on the table, but also scale back on the risk to help mitigate some of that volatility. And it's been working very well. And we think in this environment where, it's not certain, we don't know where it's going to go, or when this recession is going to hit. I mean, we've been talking about a recession for a couple of years. It's a good place to be able to benefit on both sides. So I think we've been cautiously optimistic here.
So if I recall, the probability of a recession in the second quarter was much higher than it was to now. And Stephen, what's the current?
Right now, some economists are saying there's a 30 to 35% chance of a recession.
And it was well north of probably double that. And so there's still a lot of headwinds. There's still a lot of challenges that have not been resolved. Yet the markets have shown resiliency. And they've kind of been somewhat agnostic to a lot of the political and economic challenges and uncertainties that we've started to see. Whether that trend continues or not, who knows, right? And so although we have a lot more information than we did several months ago, really just as far as like what kind of the true inherent risk of, in particular, tariffs and some of these other headwinds, there's still a lot of room for pullback.
And volatility, which is why we think the equity hedge is what makes sense right now, because that helps mitigate the volatility. We think no matter what, we're probably going to be at an elevated, situation for that. Whether stocks do well or not in the next year, there's still probably going to be a lot of ups and downs, and we want to protect against that.
In our last routine rebalance, we did scale back our hedges a bit. We brought them what I would consider like one step down and moved back towards our more traditional asset classes. But we've still maintained a fair portion of those hedges. The goal, I think, is over time to continue to scale those back long term. We do want our equities to participate in their full market growth without the need for the hedge. That being said, I think there's a lot that we still need to see worked out economically and politically before we go fully back to our targets. But that's what we look at, and that's what we evaluate on a regular basis. And the funny part is sometimes a client will say like, hey, should I be doing anything with my portfolio right now? And the reality is that's exactly what we do. We are constantly evaluating these things and making timely and tactical adjustments for you. So you don't really have to even think about that because we are already taking that obligation off of your responsibility list and making those adjustments as we see fit. And we'll continue to do that. And in times of volatility, we might do even more. So, that's a big part of our value proposition is that we are always thinking about these things. So,
right. And that's part of the reasons we do these videos as well, to share with you how we're processing this information and thoughts and how that's translating into action in your portfolios. We do most of our work, believe it or not, is actually done when you're not here in the office. So, we will continue to do that and advocate on your behalf in your portfolios and focus on that data-driven process to help make sure that we make the best decisions for you and your portfolio. And you can expect to continue to see additional documentation of that, emails and videos that we plan on doing to communicate that, as well as having those communications and meetings. So hopefully you'll find that helpful.
Obviously, we touched a little bit about inflation, so that still remains to be a concern, particularly with some elevated selling price inflation data from the past 2 months. So as far as the Fed's dual mandate, which is, to remind people, is maximum unemployment and stable prices, they have some headwinds coming in with there, and particularly, like you mentioned, Josh, stagflation, which is essentially those two items, unemployment and inflation, moving in the same direction. Which is not a good thing, correct, yeah. So some interesting roads ahead of us when it comes to that portion. So
yeah, the recession risks are lower than they were several months ago, right?
Correct, from like Q1, Q2, yes, they have dropped about 20, 30%.
So no interest rate decreases on the horizon.
So that's interesting because the bond market did price in, 5 to 8 rate cuts at the beginning of 2025. And we've zero, correct.
Presumptively, though, there's probably still 1 or 2.
Maybe, yeah.
Right.
Likely,
1 to 3.
with seeing some of this data come out the way that it has.
Correct, yeah. So
we know Trump wants it done.
Absolutely, the POTUS does want that taken care of. So, speaking of, the president, we did just have that big, beautiful bill passed through Congress and also the Senate too, which there's a lot in that 869-page document. So a lot to unpack, and ultimately does impact kind of what we do here today and in the future as well. So.
Yeah, and we're really starting to comb through some of the key details, in particular the tax changes and some of the new things like the new Trump account and how that can impact some potential future saving strategies for young children. A lot of this is literally fresh off the press. Not all of the details have really even been ironed out. But as these details become more readily available, we're digesting them, and then we will be reaching out with kind of our own thoughts on that. We'll probably even do some more videos, and then directly starting to communicate and correspond with clients if there's any actionable items like opening up a new account or using any tax advantage strategies that may be relevant with some of the tax changes.
Yeah, usually when one of these things gets passed, it takes a while for the actual interpretation of that to make itself clear. So we always are looking for ways to help improve our clients' financial situations, and part of our job is to synthesize that data and figure out what makes sense for you. So we will be definitely communicating with you on that individually and on a mass basis as well.
But we know 2 things: it's big and it's beautiful. Yeah. Right, so
beautiful is very subjective. Yeah. So. Any other things we'd like to add? We kind of covered all of the things on our agenda here today.
Yeah, I think we have. We try to keep this relatively brief. I would love to hear from clients if they have any ideas about any educational videos or anything they'd like to hear more about in these videos. I know we've been really working hard to ramp up our communication on social media as well as on email. So please, we're always an open book. Share with us what would be good for you. We want to make sure that we're communicating the right information, and also, we're not here to regurgitate the news. We want to tell you what our thoughts are, and we're always just a phone call away. So thanks for watching today. Please don't forget to like us on Facebook and subscribe to all of our good stuff and read our newsletter, and give us a call if you need us.